Hi everyone, I'm Jeff Montgomery and welcome back to the Montgomery Financial Channel. If you're approaching retirement or already there, you've probably heard of required minimum distributions or RMDs. But what exactly are they and why do they matter to you? In today's video, we're breaking down everything you need to know about required minimum distributions. I want to make sure you're not caught off guard. So let's go ahead and dive in. First off, let's answer the big question. What is a required minimum distribution? Simply put, an RMD is a withdrawal that the IRS requires you to make from your tax-deferred retirement accounts every year, starting when you reach a certain age. This applies to accounts like IRAs and 401ks and many other types of tax-deferred accounts. The key here is that you must start withdrawing once you turn 73 or 75, depending on the year in which you were born. More on that in a minute. So, which accounts are we talking about specifically? If you're 73 or older and you have one of these types of accounts, you're likely going to need to take required minimum distributions. Those accounts would be things like traditional IRAs, SEP IRAs, simple IRAs, 401ks, 403bs, 457bs, some profit sharing plans, and some other types of defined contribution plans. Now, a quick note, I said age 73. Keep in mind, for certain folks at 75, we'll get into that in a little bit. Now, if you are still working and you have a 401k or a profit sharing plan, you might be able to delay your RMDs until the year you retire. Make sure you check with your plan administrator to see if that applies to you. Now, what if you have a Roth IRA? Well, great news. You do not need to take required minimum distributions from a Roth IRA because Roth IRA are funded with post-tax dollars. The IRS doesn't require you to withdraw funds, and you can let that money grow tax-free for as long as you like for qualified distributions. So, why is the IRS requiring you to take money out of these accounts, take these required minimum distributions? Well, it's because retirement accounts like IRAs and 401ks are funded with pre-tax money. The government is allowing you to defer paying taxes on those funds while they are inside that account and growing. But eventually they want their cut, which is why required minimum distributions kick in as you hit those retirement years. Now, let's talk about the timing of required minimum distributions. Your first RMD must be taken by April 1st of the year after you turn 73. So if you turn 73 in September, for example, your first RMD would need to be taken by April 1st of the following year. That's your very first RMD. But if you were born 1960 or later, that age goes up to 75. So after your first RMD, all subsequent RMDs must be taken by December 31st each year. Don't forget, if you wait until April 1st of the following year for your first RMD, you'll have to take out two RMDs in the same year, one for the previous year and one for the current year. That could put you into a higher tax bracket, so beware of that. There's an important thing to know that RMDs are taxable. That means the money you withdraw from your retirement account will be added to your taxable income for that year. And you'll pay regular income taxes on it if you are susceptible to income taxes over and above your standard or deductions itemized. The amount you need to withdraw varies each year. It's based on your account balance at the end of the previous year, and the IRS uses life expectancy tables to determine how much you need to take. Your financial advisor should be able to help you estimate exactly what your minimum distribution will be. Yes, you can. I know what your question is. Can I take out more than my minimum distribution? Of course, it is a minimum distribution, not a maximum distribution. You're allowed to take out more than the required amount if you want to. But just remember, you'll pay taxes on the entire amount you withdraw, not just the required minimum distribution. Okay, what if you have multiple IRAs, like traditional IRAs and SEP IRAs? You don't need to take an RMD from each account separately as long as it's an IRA. You can aggregate your required minimum distributions, and you can take the total amount from either one of those accounts or split it between them. But, and this is important, from workplace accounts like 401ks, you cannot combine RMDs. You will need to take an RMD from each one of those accounts individually. Make sure you pay attention to that. Now, what if you miss taking an RMD or you don't take the RMD? It can be costly. The IRS may impose a hefty penalty, 25% of the amount that you should have taken plus taking the amount that you should have in the first place. So it's really important to stay on top of these withdrawals. But here's a fun fact. If you're 70 and a half or older and you have an IRA, you can actually donate your required minimum distribution to charity. And you can possibly avoid the taxes on that. It's called a Qualified Charitable Distribution, or QCD. Not only can this apply and help you give back, but the donation can also be excluded from your taxable income. And get this, up to $108,000 in 2025. And you can do that every single year if you're charitably inclined. Talk to your advisor about this if you want to explore this option. And lastly, some retirement accounts allow you to automate your required minimum distributions. Put it on a systematic distribution plan. This can make it easier to stay compliant and avoid missing deadlines. Check with your financial advisor or your account custodian to see if this is an option for you. Very important to do. And that's a wrap. That's our breakdown on required minimum distributions. Hopefully you now feel more confident in understanding required minimum distributions and how they might affect your retirement plans. I hope you found this information and this video very helpful. Give it a thumbs up. And don't forget to subscribe to our channel if you want more retirement and financial tips. I'm Jeff Montgomery, and I'll see you next time.